Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack key developments in credit, let's explore the macroeconomic forces shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. In today's episode, we're focusing on a few stories with significant implications for the market. First, we'll look at how the new EU-US tariff agreement is affecting European auto manufacturers, as revealed through their second quarter earnings and updated guidance. Then, we'll turn to the UK auto finance market, where a recent court ruling has given domestic banks some welcome relief and may just offer a bit of unexpected stimulus in a bleak economic outlook. All right, let's dive in. Last week's tariff agreement between the EU and US was closely watched by many sectors, but none more so than the European automotive industry. While some industries are still assessing the full impact, autos remain among the most exposed. As of April, US tariffs on European automotive imports had been raised to 27.5%, impacting second quarter results. The EU-US trade deal has now brought that down to 15%, averting the previously threatened increase to 30%. Still, this is 6 times higher than the pre-trade war baseline of 2.5%, so the relief is relative, not absolute. Now, let's start with Volkswagen. They have cut full-year operating margin guidance to 4 to 5% from 4.5% to 6.5%. On top of that, they declined to comment on whether price increases would be passed on to consumers. Stellantis, they are expecting a full-year tariff hit of 1 to 1.5 billion euros, reducing their adjusted operating income from mid-single digits to low single digits. They have offered minimal price pass-through. Instead, they are cutting volumes and adjusting production to help absorb the costs, particularly by reducing US imports. Mercedes-Benz, now they have lowered EBIT margin guidance to 4 to 6%, down from 6 to 8%, and they have no planned price increases for 2025, and instead are focusing on cutting costs. Volvo Cars withdrew their guidance altogether back in April, but previously it was around 7 to 8% EBIT. They have looked at scaling back lower margin products in the US and instead shifting their focus to higher margin models rather than raising prices. Porsche, they have reduced their return on sales guidance to 5 to 7% from 6.5% to 8.5%. The CEO signaled that their view is this is not a storm that will pass. They have currently no US production based, so they are passing on part of the tariff costs on to consumers, and the rest is being absorbed in margins as I outlined. Jaguar Land Rover, they are lowering their EBIT margin expectations to 5 to 7%, down from 10% previously. Currently, they are exploring price adjustments and continue to optimize production to help navigate the tariff impact. The BMW Group, they have maintained their 5 to 7% EBIT margin guidance, and they have no price hikes planned. BMW's substantial US manufacturing footprint gives it a strategic advantage, and unsurprisingly, the CEO downplayed the tariff impact. The Renault Group, they are limited in terms of their US exposure, so they have a minimal direct impact, but they have still trimmed their operating margin guidance to around 6.5% from previously 7% plus. So what is the takeaway from all of this? The tariff burden is far from uniform. Manufacturers with limited US production and lower margin portfolios are more exposed. And with tariffs still well above historic norms, European production facilities could see reduced activity, raising concerns about employment and regional output. That said, the impact, at least for now, is manageable. It's not business as usual, but it's also not a disaster. At a 15% rate, the industry appears to be absorbing the shock through a mix of margin compression, cost-cutting, and strategic reallocation. Turning to the UK auto finance world, a recent court ruling has tilted the scales in favor of banks and finance companies in the long-running dispute over undisclosed commissions in auto finance transactions. The court found that compensation should only be paid in the most serious cases of mis-selling, sharply reducing estimates for potential payouts from over £30 billion to closer to £9 billion. The final word now lies with the Financial Conduct Authority, which must determine how to implement any redress. The FCA chief, Nikhil Rathi, has expressed a desire to see an end to these large-scale compensation episodes, but the reality still depends on the behavior of financial product providers. Chancellor Rachel Reeves, in her Mansion House speech, also suggested reforms aimed at reducing the prevalence of mass redress, including changing the complaint system as well as interest rates used in historical compensation calculations. But is there an unexpected upside to these payments? Well, interestingly, these payouts, if dispersed soon, could actually offer a modest boost to the UK economy. We've seen this before. The PPI, or Payment Protection Insurance scandal, resulted in billions in compensation between 2011 and 2019, with payouts peaking in the 2012 to 2014 area. Economists estimate that these payments added 0.1 to 0.2% to UK GDP during those years, largely because they flowed to low and middle income households with a high marginal propensity to consume. While this auto finance case is smaller in scale, it could provide a similar, if more muted, stimulus, something that Rachel Reeves may actually find quite welcome. Why might the Chancellor need that boost? Well, according to the Institute of Directors, business sentiment is at its most pessimistic level since the pandemic and the 2022 mini-budget crisis. Over 80% of surveyed leaders were very or quite pessimistic, and the overall sentiment score hit a record low of -72. Their main concerns are focused on costs and wages, with over half expecting them to be somewhat higher in the next 12 months. They have very low expectations for the ability of the government to support growth, with 66% expecting the Labour government to be very unsuccessful in supporting growth. The top areas that they would like to see the government change to support them are taxation, the cost of wages, and a reduction in regulatory burden. Though I am not sure that that would really change in a positive growth environment. However, a degree of context to all of this does matter. The survey has been active since 2016, or at the time of Brexit, and has only been briefly positive 4 times. After Brexit, the 2019 general election, the COVID-19 vaccine rollout, and very briefly following Labour's election win just over a year ago. They appear to be a very fickle bunch. Other metrics, such as S&P Global PMI for July, tells a slightly better story, showing the UK holding at 51.5, just down from 52 in June, indicating continued modest expansion. A further but brief important note, the European Banking Authority has released the results of its latest stress test, and the verdict is, well, European banks are passing with flying colors. We have highlighted their relative strength before in both research on KBRA.com and previous podcasts. The scenario modeled a sharp global slowdown alongside geopolitical tension, tariff shocks, and supply disruptions, eerily close to current reality. Even under a severe scenario, European banks could withstand over $500 billion in losses, showcasing the sector's resilience. The post-GFC regulatory regime is paying off. Perhaps now, with equity markets giving banks credit for their stronger balance sheets, we may see fewer SRT transactions and a bit more capital markets activity from the sector. So what does all this mean for investors? On the equity side, markets remain buoyed by the AI narrative and continue to look expensive, although European equities may still offer better relative value. On the credit side, fundamentals remain stable and default risk appears contained. However, as the tariff impact deepens, especially into Q4, we may see a shift in market sentiment. The clarity provided by trade deals helps, but the economic consequences still need to play out. The results of the geopolitical tensions are likely to play out in the data as we head into the end of the year. As a result, we maintain our views. Some of that uncertainty risk may have been removed with trade deals now providing some degree of clarity, but their full impact still needs to be worked out. That's it for this edition of the Credit Compass. There won't be an episode for the next 2 weeks, so please enjoy the rest of your summer. If something major happens, you'll just have to wait a little bit longer to hear our take. And if you missed the sound of my voice, well, feel free to revisit past episodes in the meantime. For now, enjoy the break and watch out for new episodes soon. If you enjoyed today's episode, don't forget to follow, rate, and share. If you have any questions or topics you want covered, please drop us a line. We'd love to hear from you. For deeper credit research and ratings, please visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.